This is Efrem Hoffman broadcasting live from NakedSwanTrading.com on May the 23rd at 3:52 p.m. What you see on the screen over here is a shot of the NASDAQ QQQ symbol. That's the Power Shares Trust Series for technology, top 100 technology stocks. And what I'm showing here is a setup for a market sell-off going potentially into tomorrow. Okay. Earlier yesterday, I put a warning out on Naked Swan Trader indicating that the market was going to roll over in the afternoon after we had that dramatic rally in the morning. And it certainly did roll over in the afternoon yesterday and came down. And now we're basically getting the retracement back towards that high that we had yesterday. Now the ominous setup over here is that we have a confluence of boundaries, okay, which when breached will result, in our perspective, in a very large-scale sell-off that would impact short-term intraday traders as well as position traders. And because this is all part of a larger scale move that started back in April and early May, it's going to bleed into something far more significant that could be damaging to long-term buy and hold investors. So this rally over here is nothing but a dead cat bounce. It could fail in the area of 62.91 to 63.55, but the key thing to keep in mind is what's going to happen as this stalls in the area, and there's all kinds of overhead resistance in the long term here, that these lower boundaries that you see over here are going to flatten out, and therefore the next time we get underneath 61.16 for more than 8 minutes, it's going to then gap down to the 60.33 area. If we get underneath 60.33 for more than 8 minutes, you're going to see a large-scale multi-point move in the NASDAQ in a very short period of time, taking you into the 56.50 to 57 area. And we will put further updates on NakedSwanTrading.com to indicate how this market is progressing down to those areas. The NASDAQ, now I'm going to show you the NASDAQ 100 futures that corresponds to the QQQs. Okay, and I'm going to take you to a 34-minute chart where each bar represents 34 minutes. And what you see over here is that the market rallied yesterday. We got that retracement in the afternoon, as we indicated, at around 11 something in the morning. And we actually also indicated that after around 1:19 in the afternoon, it should start accelerating down, as it did for the intraday trade. And now we're just coming back up into resistance. Any boundaries that are sloped up act as interference or resistance. Any that are sloped down act as support. Now you can see here there's some interference here as the market's just pushing into the area between 25.40 and 25.60. But the dangerous part is we have a confluence of this yellow line overlapping this navy boundary at this level of 24.63. So if we get prices trading underneath there for more than 34 minutes, and it's not a question of whether they will get to that point. It's just that when they do get to that point, interesting things will take place. You're going to see a liquidity blackout, almost a whole bunch of orders by informed traders shooting into the market on the sell side, a lot of the market makers being trapped and therefore holding back on buying the market, and that's going to withdraw liquidity from the market and cause something akin. I'm not going to go as far as saying a flash crash at this time, but it's going to feel like a very different type of one-sided action to the downside, following that movement. And retracements, once we actually get underneath that level for more than 34 minutes, you're going to see retracements limited to this level over here where we are right now. And if it even gets up there, we may just not even be able to get back above the level that we break at that 24.63 level. So that's our outlook in the immediate term for the NASDAQ. And In terms of other markets, they also look pretty weak. I'll take you to one of our prime plays right now, which is high yield dividend equities, like such as the DVY, as well as the SDY, okay, which is the S&P Spider dividend series. And while they've been holding up well over an extended period of time since that August rally into the April period, we have recently breached some very, very critical levels in the dividend series. And right now what it's indicating is that we are capped. This high is locked in place, and we're likely going to blow through and come all the way back down into the mid-30s, at least into the mid-40s area. So we're talking about a very sharp drop for stocks that don't normally drop that drastically. And this is partly due in part to the fact that the spreads are widening between corporate debt and government treasuries. And that indicates that trouble is brewing in the bond market and high-grade corporate debt market. Okay, and it's not just junk bonds in the corporate debt market, but it's also the high-grade bonds like the LQD that are at risk here. And when those spreads start to widen, it means that the balance sheets are going to be impaired. Their ability to raise capital, okay, is going to be more difficult. And in order to do so, they're going to have to raise the yields that they're going to pay the bondholders. And when you get into an economic slowdown that we're seeing, it's going to impair their profits. And actually, the expectations that investors have that they're going to continue providing the same kind of dividend stream as they did during good times is going to be a false hope. And what's going to end up happening is dividends are going to come down or be eliminated altogether in the mid and lower tier companies, and even substantially reduced in the bigger tier companies as the global slowdown emerges. And that is being reflected in the fact that the bond vigilantes are requiring higher interest rates to be paid on corporate debt. And as that happens, there's a lot of bets by a lot of the large banks betting against the fact that spreads aren't going to widen too terribly more on the corporate bonds relative to treasuries. But what we see... But excuse me, that loud noise was the closing of the market. So what we see here is that the corporate the bond market and government treasury spreads in the yields are going to widen substantially, and any big banks betting against that could get hurt severely, especially if they're involved in derivatives activities that guarantees these corporate bonds. So that could definitely cause an increase in the mismatch between revenues and spending, and that will make it more difficult for corporations to manage their debt going forward. And that will put even further pressure on dividend yields, and that explains why, in our avenue of analysis, why the SDY and DVY dividend-yielding stocks will get crushed in this next phase of the bear market. Thank you very much for joining me, Efrem Hoffman, at nakedswantrading.com this May 23rd, 2012, ending at 4:01 p.m. Looking forward to having you all at our next webinar series that's going to be held every Sunday, and we will shoot a blast out to people that actually subscribe to our updates on our webpage at nakedswantrading.com. Okay, and at that point we'll blast you out an email, and then you could actually participate in our weekly webinars. Thank you very much for joining us, and looking forward to hearing from you soon.